Recession. Since the beginning of the Great Recession in 2008, those who make their living in the financial industry have dreaded the very mention of this word. Despite this, the United States of America has, for the most part, been protected from these economic slumps. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. With the notable decrease that occurred in March of 2020, as a direct result of an epidemic that was brought on by a black swan being the sole exception to this rule, the S&P 500 index has returned a total of 357% since 2010 with little to no difficulty, which means that people who had the good fortune to invest in the US economy during this golden era have seen their portfolios grow far beyond the predictions of financial experts. Nevertheless, the financial markets are currently going through a significant transition that has raised concerns among all participants, including JP Morgan. Drawdowns have been extremely rare, and buying the dip has been an extremely rewarding strategy when they have occurred. As a result, investors have had virtually no cause for concern during the historic bull run that followed the recession that has occurred over the course of the past 12 years. Investors can now enjoy virtually worry-free investing as a result of this development. Since 2010, the S&P has only experienced 3 drawdowns of 15% or more, and after each drawdown, the market quickly returned to fresh all-time highs. Since 2010, why is everyone so concerned about a recession, given that the current drawdown is nothing remarkable, at least numerically speaking? People have made a speedy recovery in the past after experiencing problems of a similar nature. However, the solution lies in 2 separate locations, and once you discover where it is, you will understand why everyone is so concerned about it. It used to be easy for us, but after being taken advantage of financially for a number of years, and particularly after March of 2019, we no longer have the same level of protection that we did in the past. As a direct result of the significant inflation that has been taking place recently, the Federal Reserve is currently faced with a challenge that it has not had to deal with since before the 1980s. In order for the Federal Reserve to be successful in overcoming this obstacle, they will need to raise interest rates and reduce the amount of assistance they provide. Many industry professionals are of the opinion that the era of easy money has come to an end, and that the market will need to learn how to thrive in a world where the United States Federal Reserve, if these professionals are correct, then the market will need to learn how to thrive in a world where easy money no longer exists. However, when looking at the S&P 500, it is difficult to determine just how dire the situation currently is. The selling that has occurred as a direct result of making this assumption has reached unprecedented levels. Although the S&P has lost 14% of its popularity since 2020, what exactly is taking place in this location? Suppose the market is, in fact, falling apart. Why does this one particularly statistic, which is by far the most important of all, appear to be holding steady? Therefore, if we are truly on the verge of entering a recession, where is the significant drop in the economy that we should be expecting? There was an increase in the spider population in 2008 that was equivalent to 50% more than the previous year. What exactly is it that is keeping the markets from moving in any direction? Apple is the factor that is keeping order in a market that appears to be in a complete disarray. In the opinions of a large number of industry professionals who believe that Apple is the factor, if Apple's stock price falls, it is highly likely that the market as a whole will also fall. There are growing concerns about the reliability of the report, despite the fact that the vast majority of analysts gave a positive reaction to its most recent results call. The price of its stocks has decreased by almost 14% since it reached its all-time high. It is claimed that Apple executives were asked 3 times in the most recent earnings report to explain how the demand from customers is shifting, and each time they refused to answer the question. This behavior is typical of the way the vast majority of participants in the market behave. The ability of executives to hide the suffering for only a limited amount of time before changes in consumer behavior and the actual suffering begins is limited. This ability is limited. Even large banks are getting ready for a potential economic downturn, and this is one of the reasons why. The process is laborious but fraught with the possibility of catastrophic failure, much like a train wreck in the making. Investigate the various possibilities and give it a shot. Investors from all over the world ought to pay attention to what Michael Feroli, the chief US economist at JP Morgan, has to say about this subject. So I think the recession, as I understand that the recession narrative or discussion is really about perhaps next year, not about next quarter. I think most people recognize that the momentum in the economy right now is pretty favorable, as you mentioned, the jobs number looking very timely and looking very strong. But as we see these financial conditions tighten, many of what you just talked about, stocks down rates, up dollar away up over time. If this continues, then you set yourself up for a scenario where maybe a few quarters down the line, recession becomes more of a possibility. As Michael pointed out, as a result of the Federal Reserve increasing interest rates multiple times over the course of the next year, a couple of things are taking place as a direct consequence of this. The dollar index has reached all-time highs, which means that imports are more affordable while exports are more expensive and less competitive on the international market, because the Federal Reserve continues to raise interest rates, which will make it more difficult for American companies to export their products overseas. If mortgage rates continue to climb, the affordability of housing will plummet, which will undoubtedly result in the housing market coming to a grinding halt. Investors and traders are being paralyzed by a fear of stagnation at the moment, because the current state of affairs has the potential to result in both inflation and a recession. We can consider it a sword with two edges. The rise in prices is a problem in and of itself, but when coupled with widespread unemployment and abysmal economic growth, the results are catastrophic. They're not just doing this for the sake, for the fun of it. They actually want to take financial conditions and slow down the pace of spending growth in the economy. And by giving the impression that it would not even consider raising interest rates by 75 basis points, at the most recent meeting, the Federal Reserve appears to have lied to us once again. Others interpreted this as evidence that the Federal Reserve is incapable of addressing the issue of inflation on its own. Suppose inflation remains on high trajectory when the CPI is published the following week. In that case, the Federal Reserve will be forced to make a difficult decision, which will undoubtedly determine the short-term direction of this market. Even though no one would admit on television, the simplest solution would be to either destroy the economy or let inflation get out of control and spiral out of control. In order to avoid a catastrophe in the long run, we will need to go through some discomfort in the short run to make progress toward a goal in the long run that is looking less and less likely to be accomplished. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.